everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's also the CEO and founder of Flying V, our digital marketing partner. Robb, how you doing?
Doing great, Gary. Running around, well, I'm not running around, but my wife is running around right now. I had to drop her off. She's running the OC half marathon this morning. So, yeah, up and at 'em on this. We're filming bright and early Sunday morning, but yeah, it's going well. How are you?
I'm all right. Outstanding though. Good for Alex. Great to hear she's returning to competing, to running again. How many years has it been since she ran a half?
I think the last one she did was 10 years ago while she was in college. So her goal is to best that time that she ran 10 years ago, which I think was right around the 2 hour mark for the half.
I think anytime you're looking to improve after you've aged 10 years is absolutely phenomenal. Good for her. I'll be cheering for her, and you can report on her progress next week when we do the five things.
I definitely will do that.
All right.
This week we've got another great episode as always. Seems like we're really picking up steam with the five things and getting a lot of good response from the community just with these videos that we're pushing out, and Gary always keeping us in tune, which is awesome. This week we're covering the Fed again, Bank of Japan, circling back to that. Talking about the people and the folks up in Washington, D.C., some security, economic indicators, growing GDP. We've got a ton to cover today, Gary. You ready to rock and roll?
Let's go.
All right. This episode of the five things is the everybody shut up issue. So I don't know if Gary just woke up on the wrong side of the bed, or he'll have to give us a little bit more context about that. So,
It was
uh,
it was a combination of people in Washington saying stupid things and me just
all
being a
right.
little cranky, and sometimes that's the title. What can you do?
I love it. Thing number one this week, Gary, we've got the Fed moves from hawkish pause to dovish pause. Tell us more about that.
So the Federal Reserve meets, I think it's 10 times a year. They have 2-day meetings. And at the end of those 2 days of meetings, they issue a press release. And then shortly after that, Chairman Jerome Powell will give a press conference where he reads a prepared statement and then tries to not look annoyed while every single reporter in the room asks him 27 versions of the same question, which is, when are you going to lower rates? And he says, well, we're data driven. We don't know. It's not today. And, they keep trying to pin him down. And at some point, he just looks so annoyed with the entire room, which, in fairness to Powell, I would look annoyed too if 27 people all asked me 27 versions of the same question. So the press release came out, and as expected, the Fed kept the Fed funds rate, interest rates the same. There was no change. That's pretty much what everybody knew would happen. And my read on the statement was it was slightly more hawkish than it had been the prior month. Now, but for people who are not so familiar with finance speak or economic speak, hawkish means favoring higher interest rates. Dovish means favoring lower interest rates. And last month, the language the committee had used was ambiguous regarding where they were in the economy. This time, there was no ambiguity. They reiterated, I'm quoting from the press release, that they're strongly committed to returning inflation to its 2% objective, and then admitted there'd been a lack of progress in recent months toward getting there. That is pretty clear, saying, hey, the economy's running hot. We're not getting there on inflation. No way are we touching interest rates. That's a pretty hawkish message. And yet the market responded in the opposite direction. You would expect a hawkish message to take stock prices down, and that's not what happened. By the next day, stock prices were skyrocketing, and that was different from what anybody would have expected.
Gary, you talk a little bit in the takeaway about quantitative tightening, QT. Why did the market react positively the way it did with the intention to start to taper that quantitative tightening?
That's the key question, Robb. So first, let's explain to people what quantitative easing and quantitative tightening are. Historically, if we go back a few decades, the one policy tool the Federal Reserve had and used was changing the Fed funds rate. And it's kind of a blunt tool, but pretty effective in getting inflation under control or trying to help expand the economy. Um, And, a number of years ago, they discovered this great power of quantitative easing and quantitative tightening. And that simply means using the Federal Reserve balance sheet to add liquidity to the system. So in quantitative easing, the Fed basically issues bonds, buys the bonds back, stores the bonds on its balance sheet. But when it buys those bonds, it puts liquidity into the system. They put dollars in the hands of banks and other market participants, and that does make its way through the economy. Now, the issue is the Federal Reserve during COVID blew up a $9 trillion balance sheet. For people who aren't familiar with those numbers, it is obscene. If we go pre 2008, before that financial crisis, I think the Fed balance sheet was somewhere around $1 trillion. They do need a certain amount of liquidity in the system to deal with money flows one way or another. 9 trillion is obscene. And so when they decided that they wanted to start addressing inflation, they started to reverse what they'd been doing. And what that means is they were letting those bonds roll off. And when that happened, money came in to pay the Fed for the bonds that they had sold before. And so as that happened, the Federal Reserve balance sheet was declining by a little bit every month. The thing is, a little bit every month for a year and a half, and you pretty quickly get to the point where you've taken $1 trillion, $2 trillion off the total. It was a meaningful number. So the Federal Reserve press release, in this case, I'm grabbing the numbers here, they announced an intention to start to taper quantitative tightening. And what that means is they're going to keep letting the bonds roll off the balance sheet. They're going to keep engaging in quantitative tightening to reduce the size of the Federal Reserve balance sheet, but they're going to do it more slowly. And the big change is the monthly net redemptions on Treasury securities are being cut from 60 billion a month to 25 billion a month. That's a difference of 35 billion a month times 12. That slows quantitative tightening by $420 billion a year. That's a big number. And so the market said, aha, the Fed, they're not back at quantitative easing, but they're reducing their tightening by almost $500 billion a year. That's a meaningful number. And once the market figured that out, went straight up.
Gotcha. Thanks for breaking that down, Gary. Thing number two, we're moving on to the Bank of Japan, BOJ, the ineffective intervention of the Bank of Japan.
We've been speaking and writing about the issues in Japan for a year and a half. And fortunately, more people now are starting to discover this. They're starting to realize it's a problem. I'm actually really glad that other people are starting to catch up with where we were and realize this is a giant problem. So the big problem with the issues in Japan is they ran up an enormous amount of debt. Their debt to GDP is 260%. Generally above 100%, people start to get concerned. At 260%, they have a giant problem. And the reason that the Bank of Japan was able to do this is because they set interest rates at negative. They kept their version of the Fed funds rate at a negative number for something like 9 years. And then, as we reported here in the five things last month, the Bank of Japan said, okay, we're going to positive, except they set the reference rate at between 0 and 10 basis points. So, they went positive, but at the midpoint, that's 0.05%. And that's not really meaningful. So the issue with having your interest rates so low is people don't want to hold your currency. You want to hold a currency where you can at least earn a decent rate of interest. And so as the US Federal Reserve, the Bank of England, the ECB, the European Central Bank have all raised rates, Japan has lagged, and that's caused the yen to fall. And the yen in the last couple of years has gone from about 102 to the dollar to a week ago, it was approaching 160 to the dollar. This is a massive currency devaluation, and the currency markets moving 2 or 3% is a big deal. These guys let their currency fall almost 60% against the dollar. This is a gigantic problem. So Japan has a substantial amount of foreign currency reserves. And what they did was on Monday, they spent, yeah, there it is, a $38 billion in their foreign currency reserves defending the yen. Basically, they were selling US Treasury bonds using the proceeds of that in dollars to selling dollars basically to buy the yen. And that that rose the value of the yen that caused the value of the yen to increase from about 160 to the dollar to about 155. And the problem was because they didn't change any of the structural issues behind this, you end up in a situation where the market says, okay, well, if you're done intervening, we're now going to take the yen back to where it was. And literally, like a day or two later, it was back at 158. And so, all of this intervention bought the yen, 1 or 2 yen per dollar, a meaningless amount. So they went back and they spent another $24 billion, and they caused the yen to rise again right around 152, 153 to the dollar. And guess what happened? By the next day, they were heading back down, right back down to where they were. And the problem with the approach that the Bank of Japan is taking is they're not changing the structural issues behind it. They're just spending money to support their currency on a temporary basis. Now, what ended up bailing them out was the Federal Reserve tapering quantitative tightening, which we just spoke about. And then also on Friday, we got a weak employment report that caused people to think that the Federal Reserve might be closer to pivoting toward lower rates than they had been before. And so that's basically what's happened there. But the Bank of Japan, at some point, this strategy, they're going to run out of foreign exchange reserves. They still have plenty, but this is not a strategy. They need to change the structural issue that's causing the problem.
So they had these two interventions, Gary. Yeah, 159 to 155, and then went back down again, back to 158, right? So it seemed like the net was essentially nothing happened, more or less. What would cause this to actually be a positive outcome for the yen, if any, or what would that market scenario look like if these interventions were to actually take hold or actually do something to improve the value of the yen?
There are two options that are possible here. Sorry, there are three. One is they could do nothing and watch their currency continue to slide. I don't think that the Bank of Japan has it in them to do that. That's going to create hardship for their people. Again, nobody likes inflation, and another way of describing inflation is to say the purchasing power of your currency is declining, and that's where the Japanese people are right now. A second option is that they raise interest rates, and that would cause the yen to rise. The problem with that approach, if you're the Bank of Japan, is if you raise interest rates, and your debt to GDP is 260%, you end up with a budgetary problem, right? Here in the US, we've been talking about heading for something like $1.6 trillion of interest expense, and it's pushing out other spending and causing more debt issuance. That's where Japan would be. And so the only thing they're going to be able to do to pay the higher interest on their debt if they raise rates is going to be to print more yen to pay the debt, and printing more yen leads to more inflation. And again, this is why we call it a debt death spiral. That's how we've been referring to it. The final option, and this is the reason why the yen rose on Friday, is because with a weak employment print in the US, what Japan is really hoping for is a weaker economy here in the US that would cause the Federal Reserve to lower interest rates. That would reduce the spread between people holding Japanese government bonds and people holding US Treasury bonds. That spread is the difference between the interest rates, which right now is in the neighborhood of 400, 500 basis points, which is a lot, 4 or 5%. And so if that were to happen, Japan would be bailed out of this problem. And, in the US, we'd be facing higher inflation, but they'd have a stronger currency.
Great stuff. Great analysis there, Gary. Moving to thing number three, one of my favorite topics, as always. We've got Janet Yellen back. More people in Washington, D.C. saying silly things. You were very nice with that one, Gary.
Yeah, silly was a kind word. Janet Yellen was the former chair of the Federal Reserve. She is currently the Treasury Secretary. Now, for people wondering why we pick on her so much, it's because she's bad at her job or bad at her jobs. This week, she came out and said she is, I'm quoting, concerned about the future of the American economy if the budget deficit continues to increase. Okay, so first of all, she's right. This is a huge problem, right? Unlimited spending in Washington. This is what has taken down every empire since before Rome, right? Too much war debt, foreign interventions. This is all of these empires end with overspending and too much debt. So let's give her credit. She's right. The problem is that for somebody who spent a lifetime in Washington, D.C. as an insider, and as somebody who was chair of the Federal Reserve, who's secretary of the Treasury, her complaining about the finances of the United States sort of, it's how is she separating herself from the mess that she helps create? And one of my favorite follows on Twitter, or now X, is Rudy Havenstein, who commented on this. And we'll put the image up. He commented, if you only had any influence on this over the past couple of decades, right? And Rudy is right. How can you be a lifetime Washington insider who chaired the Federal Reserve, who's head of the Treasury Department, and you're complaining about the finances of the US? This is your department, lady. This is the thing. You have one job. Do the job. Stop complaining about everybody else. Now, there are many people who thought some of our comments on the risks to democracy were intended as indirect criticism of President Trump, right? And so, previously, I'm saying Yellen is right to be concerned about the future of the country if we don't get the budget deficit under control. Now she's criticizing the candidate from the other party, and there's a great question about whether this is fair or not.
We've talked about this, both sides of the aisle, right? President Trump has been talking about trying to change the Fed to be responsive to policy goals of the White House. Current White House obviously has made it clear their desire for lower interest rates. What's the answer here, Gary, from DKI in terms of what we do with the Fed?
So, first of all, this is the second area where we agree with Treasury Secretary Yellen. She's right. She's right to criticize President Trump, and here's why. In the last couple of weeks, President Trump has come out and said if he's reelected, he wants to make the Federal Reserve, which right now is considered nominally independent, subject to supporting the policy goals of the White House. And the issue with that is, instead of having an independent Fed, and they're not completely independent, but nominally independent, that they will then be beholden to the White House. Well, Rob, I'm going to tell you something. Every person who's president is going to want low interest rates and lots of stimulus, because that makes the economy look better. It doesn't improve the economy, but free money, people like that. And if you want to have a rising stock market, rising asset prices, lots of business development, then you set up this kind of policy. And so President Trump is saying, hey, if I'm back in the White House, I want to remove the independence of the Fed, and I want them to support my policy goals. Except what that means for everybody here is that's going to mean massive amounts of additional spending, malinvestment, asset bubbles, greater income inequality, and lots of more inflation for the rest of us. Does anyone want to sign up for this? Yellen is right to criticize him, but here's the issue. The current White House, the administration that she serves, has been calling for lower rates from the Federal Reserve all year. And when Powell made it clear, you're not getting that, we're going to hold firm, higher for longer, is his response. They've said, okay, fine, then we're going to undo what you're doing, and we're going to push through trillions of dollars of additional stimulus. Remember, while the Federal Reserve can raise interest rates, Congress and the White House, by engaging in lots of stimulative spending, can reverse what the Fed is doing. And we've been talking about that a lot. And so the issue I have here is the current White House should stop trying to influence Fed policy. President Trump should stop talking about trying to influence Fed policy. Secretary Yellen should stop talking about, acting like she's had no say or influence over the economic mess we're in. She's been in a position of control and power for decades. She also should stop blaming one side for something that the administration she supports is doing. This is a bipartisan problem. And I have two policy prescriptions for all this. One is everybody should shut up. Just stop talking. Stop talking about the Fed. Stop blaming the problems on everybody else. You want to fix it, fix it. You're in power right now. Do something. The other thing is DKI is on team end the Fed. The idea that a group of unelected bureaucrats in the Federal Reserve, that they should be setting the price of risk and time, which is the most important metric in the market, is kind of a silly idea. The only thing that's worse than that is having somebody in the White House setting Federal Reserve policy. Like that's the only thing that would be worse. We should let the market set these rates and the Fed and everybody shut up. That's our view on it.
Yeah, I figured you were going to say that. And we have hashtag end the Fed. So that leads us to our next point with Gary being micro famous, maybe. I think anytime you have an imposter, that means you're definitely ruffling some feathers one way or another. So thing number 4, Gary, we'll talk about that. The practical case for biometric security. So tell us what happened over the past five or six
Yeah,
days.
this has not been fun. So last week, one of the things, Rob, you and I talked about is the deep knowledge investing initiated on a new company. We added a new name to the portfolio. We have a huge detailed report out that our subscribers have gotten. Our subscribers are up, I think, 20% in the name since we first put it on the board. So great, good for them. That's worked out well. The company, which I'm not going to name in public yet, deals in biometric security. So let's talk about why that matters. Earlier this week, I was suspended on Twitter or X, and then that actually made its way into a lifetime suspension, which was not fun. And, through the kind, diligent help of Twitter support or X support, we were able to get that reversed. And first of all, I want to compliment the support team over at Twitter. They were responsive, they were fast, they did the right thing. They got all this sorted out in about 12 hours, which under the circumstances is really fast. And they were a pleasure to deal with. And I have nothing but positive things to say about the people in the support department there. But let's talk about what happened and why it matters. So, micro famous is kind of a funny way to say it. Anybody who has a decent size account, a decent follower account on Twitter gets spoofed. There are, people committing fraud that pretend to be them. And, if you're somebody like Michael Guyot or Lynn Alden, they have imitators, people stealing their identity and trying to convince people to do business with them on a weekly basis, maybe on a daily basis. For me, it happens every few months or so. And so somebody who was committing fraud stole my name, my image, my firm name, my firm logo, my banner, and set up an account that looked a lot like me. And then what that person did was blocked me and reported me to Twitter support, right, for imitating him. And so Twitter suspended me, and it can happen. They didn't know. And then when I went to go log into my account, I got a lifetime suspension because to them it looked like I had started a second account. Now there are two accounts out there with my name, my photo, my firm name. Oh my God, right? So, um, it took hours and hours of my time. And fortunately, Rob, you were the one who pointed out to me, "Hey, we found the imposter. We found the guy." I couldn't find him because he had, of course, blocked me. Um, but it took me hours to get this sorted out. And when it happened, I was supposed to be a featured speaker on a Twitter space, speaking on the yen. And I wasn't able to do that. And these things can get serious. I know somebody who it took him months. I think he was locked out of his account for 2 to 3 months. And for a lot of us, we talk to people on Twitter, we do business there. Having that access revoked is disruptive, and it's a huge problem. Now, again, it happened to be that I was able to get a really quick response from the support team, and they were great on it. And, 12, 14 hours later, I had full control of my account, and we had gotten the person committing fraud banned from Twitter, but it wasn't a fun experience. And, anything that goes on for more than a day can create business problems.
No doubt. And so, what Gary's mentioning regarding this new recommendation, cybersecurity company, currently that's only available to premium subscribers. The full report and access can be had with a monthly premium subscription of Deep Knowledge Investing. So, if you're interested in that, please be sure to subscribe, and that'll unlock access not only to that report, to countless others. And yes, as Gary said, if you would have been a premium subscriber prior to today, you're already looking at 15-20% gains, which probably covers your entire DKI subscription for the year, or at least helps to hedge that cost. So, Gary, any other closing thoughts on that? I'm sure we'll be talking more about this in the future, but right now we kind of have that under wraps.
Yeah, so let's take a second to talk about why biometric security would matter. First of all, if there had been a biometric, so I've talked, Rob, about how good Twitter support was, and they really were. Those guys were terrific, or people. There may have been women on. I don't know who I was dealing with. Whoever I was dealing with in support was great. But had there been biometric authentication, instead of taking 12 to 14 hours and several hours of my time to get it sorted out, we should have been able to get it sorted out with a quick selfie. Here's my ID.
Right.
More importantly, let's imagine for a minute that the platform offered biometric authentication for people who wanted it. So not everybody's going to want it. Some of my favorite people to follow on that platform are on there using pseudonyms, right? Rudy Havenstein, who we talked about, that's not his real name. That was the head of the Reichsbank during Germany's hyperinflation. Stackholder, who writes on Bitcoin. Peruvian Bull, who writes on macroeconomics and has been great calling issues with the dollar. Tons of the people, Darth Powell, who's hilarious, tons of the people who I follow and whose work I really like are using pseudonyms. This shouldn't be mandatory. But imagine, Rob, if Twitter had said to me, "Hey, are you willing to pay an extra dollar a month to secure and verify your account?" Yeah, absolutely I would, because this has happened to me multiple times. And one time I got shadow banned, and this time I ended up with a lifetime ban, right? And it's stressful and it takes my time. And if they were to say, for $1 a month, we will let you secure your account and guarantee you that nobody else will be able to use your name, your image, your photo, your logos, your firm name. Yeah, I would absolutely do that. And I suspect there are lots of other people who have had their accounts and their business efforts disrupted by people committing fraud. And so that's why biometric security matters. It's a way to lock up your account so that you're the only one who can unlock it. And doing that would have saved me hours and hours and hours. It would have actually been great for Twitter support, because instead of them spending hours getting it sorted out, we could have just done this automatically, or spent, 5 minutes authenticating me once. And it
Yep.
would have been better for everyone. And Twitter could turn this into a profit center. And so there are huge advantages to this. And when people talk about the use case for biometric security, my last week is a perfect example of why we're investing in this particular stock, because we see unbelievable opportunities for people to secure these things. Now, somebody might say, it's your Twitter account. Who cares? You only have like 5,000 followers. Why does it matter? Okay. Fair point. And, my response is, okay, but what if it had been your bank account or
Mhm.
your brokerage account or your health records or your hotel reservation, right? Or your Venmo account or
Right.
your personal email. Here's another great use case: people on dating apps. there's all kinds of fraud, all kinds of like romantic fraud, people asking for money, people pretending to be somebody else. Dating apps theoretically exist to help people move from virtual communication to meeting in person. There are some security and safety issues there. Listen, I don't think being on a dating app is necessarily a huge risk to your life, but 100%, if you're on those apps, you're going to encounter people trying to commit fraud and trying to steal money and put you in a bad situation. Biometric authentication would be a great way to, if not stop it completely, slow it down a whole lot. Put people in a situation where you can't try to scam people anonymously. We see tons and tons of use cases for this. And so that's why we think there's a really big market with a lot of valuable use cases, and why I have my personal capital invested behind this particular company.
As we mentioned, be sure grab a premium subscription to DKI. You'll be able to access that report and all other premium subscription content on the website, heading to deepknowledgeinvesting.com/subscribe now. Moving to thing number 5, Gary, to wrap up for this week. Thing 5 is weak economic indicators versus growing wages and growing GDP.
Rob, one of the things that's been a huge theme at Deep Knowledge Investing for about a year and a half has been a bifurcation of the economy. And we've talked a lot about how, one week we see data that indicates one thing, the next week we see data that contradicts it. So this week, we got a lot of really negative data on the economy. The Purchasing Managers Index came in um, below 50 again. So anything below 50 indicates contraction. And it's been below 50, indicating contraction, for 17 out of the past 18 months. That is not the sign of a strong economy. In addition, consumer confidence, which does matter, was 97. Is that good? Is that bad? It was way short of the number that was expected, which is 104, right? A approximately 7% miss. That is a big, big miss. In addition to that, we talked earlier in this episode, Rob, about how Friday's employment data was weak. The reason we've stopped writing on it is because that data is so manipulated that it's just proven to be unreliable. But that data came in weak. And so we have all these indications that the economy is weakening. And yet, here's the other side of it. I got a great invitation from Tracy Schuchart at Shy Girl, CHIGRL on Twitter, to do her Mic Drop Market show ahead of the Federal Reserve press conference. And this was on Wednesday, and there's some really smart panelists on there. It was a great discussion and great debate. And a lot of them were saying, hey, listen, the economy's in great shape. We've got GDP growth around 2%, and unemployment is still below 4%. And even though the jobs information has come in a little bit weak, but in prior months it had been really strong. And that all of that's true. There are lots of jobs out there at the moment. If you want to be working, the prospects of going to get a job are actually pretty good. And so they're pointing to government data that actually shows the economy is in good shape. And these are smart people whose opinions are worth taking seriously. So we have this incredible bifurcation of opinions, right? We're getting some people saying the data looks great. And then this week we got a bunch of data saying that things weren't so good.
Yeah, I like what you used in the takeaway, Gary, of a bifurcated economy, right? Because we've talked about this a lot with job reporting and a lot of that coming in numbers that people taking up 2 jobs, right? Part-time job or full-time job as well as on the GDP side, right? I was like talking about digging holes and then paying people to
Yeah.
refill them. So, and then you've got, very bright and intelligent people on both sides of the aisle having the conversation as well. Hey, painting this as a good thing, painting this as a bad thing. Is it a bifurcated economy? Is there both sides of the argument that can be true at once?
I think that's the case. And I think that's what's going on here. This is one of those weird situations where you really can see a possibility that everybody is right, which I know sounds crazy, but let's go through it, Rob. The people on Tracy's show who were saying the economy is in great shape are looking at aggregate data. In fairness to them, when you look at that data, we're looking at an economy that is in really good shape, right? We have consistent economic growth. We have low unemployment. We have tons of jobs available. Wages are up. Consumer spending is high. And so they're looking at that saying, we don't have multiple economies. We have one economy and numbers look pretty good. And everything that they said is true. My take on it is we do have a bifurcated economy. I think the reason why the numbers that these people are talking about are good is because of excessive government spending. And Rob, you just brought up the key point, which is all government spending, whether it creates value or not, adds to GDP. And so right now, Congress is overspending by a couple $1 trillion a year. That is an incredible amount of stimulus for a country that supposedly is not in recession right now, right? And we still have an inflation problem, and they are just spraying more and more stimulus into the economy and financing it with debt. This is not what you should be doing if the economy is in good shape. And so one of the things we've talked about a lot in recent months is that almost all of the new jobs are either in government or in healthcare, which is largely funded by the government. The government is creating its own economic statistics by just printing dollars and spraying them out and hiring people. But these aren't things that create value. And I'm not negative on healthcare. Obviously, healthcare creates a huge amount of value, but that's not the whole economy here. Um, in my opinion, government spending is pushing out the private sector, and all of the new job growth has been in part-time jobs. And so what that means is that more people aren't working. The same number of people are working more jobs. So the aggregate numbers show a strong economy. But I think when we go down to the individual level, there are a lot of people suffering from they're having difficulty making ends meet. Inflation is a huge problem. Wage growth has been real, but not enough to offset inflation. Credit usage is up. And government spending is pushing out private investment and pushing out the private economy. So I do think this is a tale of two economies here where the aggregate numbers look good because the government has their thumb on the scale in a very deliberate, heavy way. And individuals, in the private economy may be facing much more difficult circumstances. And so that's the part that I'm sensitive to. I'm not a big fan of excessive government spending. I would rather individuals be making their own choices and have the opportunity to earn a good living themselves. So I think that's what's happening there. And I think we have just a huge discrepancy between the government economy and the private economy. I think that's what's happening.
Great breakdown there, Gary. I know we've been talking about that a lot, and we'll continue to monitor those things moving forward. That wraps up this week's 5 things with Deep Knowledge Investing and Gary Brode. As we mentioned, be sure to check out our website at deepknowledgeinvesting.com. Premium subscriptions start at $100 a month. We also have student discounts for any students that are interested in subscribing. Or you can also sign up for a free subscription to where at least you'll get notification of reports. Might not have access to every single report, but some stuff is ungated material. Be sure to follow Gary on Twitter now that he's back and online, which we're all happy about. And thank you, as always, for tuning in and watching. Gary, any final thoughts from you?
Thanks, Rob. Always great doing this with you. Really appreciate it. I know it's super early in California and on a Sunday. I give you a ton of credit for doing this with me, at 7 in the morning there.
Yeah, a little bit.
Um, yeah, so that's much appreciated. You always go above and beyond. Not kidding here. I want to thank the support staff at X, at Twitter. Thank you for getting me my account back. I appreciate you guys. You really did a nice job for me and did it fast, and I'm grateful for that. For the rest of you watching this, thank you so much. We know your time is valuable. We appreciate you spending it with us. If you want to like and subscribe, that's terrific. If not, just find us, tune in next week. And yeah, somebody look and see if you can find me on Twitter. Hopefully I haven't been banned again by the time you're looking. All right. Thanks, everyone. Thanks, Rob. See you guys next week.
Thanks so much, Gary.